Hi believers, this is Amit from Via Team, and I'm here to provide our weekly bite and the road ahead in the markets. The market witnessed a bounce this week from its immediate support, largely driven by improving tariff dialogue between US and India. Nifty extended gains over the second consecutive week and settled with gains of 1.5%. Nifty midcap and small cap relatively outperformed the benchmarks by gaining 2% each. Beaten down sectors like IT, defense, and PSU banks staged a strong rebound, while consumer discretionary took a breather. Key point to highlight is that the follow through strength in index on the back of the GST reforms, supported by positive development on tariff negotiation and buoyancies in global market as the rate cut expectation in the upcoming US Fed meet boosted the market sentiments. That in turn helped the index to head towards the resistance zone of 25,200. The weekly price action formed a bull candle carrying higher high, indicating a continuation of the upward momentum. Going ahead, on technical charts, we can easily say that the index will log a confirmed breakout from the resistance zone of 25,200. Further, positive outcome from US Fed meets as well as the US tariff negotiation would fuel the momentum to drive Nifty 50 towards 25,800 in couple weeks. A strong base of 24,400 would continue to act as a key support threshold. On the sectoral front, key index heavyweights like Bank Nifty and IT, carrying almost 45% weightage in Nifty 50, are getting ready for the next leg of move. Since December 2022, Bank Nifty is trading in a channelized move wherein the intermediate corrections are getting arrested within 10% average. While history suggests that buying Bank Nifty near 52-week exponential moving average has been fruitful over next 8 months. With current 7% correction, Bank Nifty approached 52-week exponential moving average, suggesting index is approaching price-wise maturity of correction amidst oversold condition and now will trigger well for a pullback. Meanwhile, Nifty IT index past 10 years data suggests that 35% correction in that particular index offers incremental buying opportunity. Currently, we are already at 33% correction. Hence, with the rate cuts, it would help the index to revive upward momentum, thereby offering strong support to Nifty. On the market breadth front, the percentage of stocks above 50-day moving average once again maintained the rhythm of bouncing from the bullish support zone of 25%. The current jump to 48% clearly signifies broadening of market participation. On the broader market front, both Nifty midcap and small cap have bounced from the vicinity of the 52-week moving average amidst oversold condition, indicating an incremental buying opportunity from a medium-term perspective. PMS institutes, including us, who were sitting on the cash for some time, have started deploying the funds as we see light at the end of the tunnel. Next week, all attention will be on US Fed rate. Rate cut is pretty much a certainty at this point, as indicated by Jerome Powell in the Jackson Hole speech a few weeks back. We just don't know whether it will be 25 bips or 50. Concluding, we believe market internals are turning positive. Nifty is hinting at a breakout move above 25,200 with a setup targeting to 26,000 in the next leg higher. Breadth across large cap and mid cap is steadily improving. Participation is broadening, even though the headline indices are still in consolidation mode. Positive market internals plus short covering risk from FIIs can add fuel to the setup. Interestingly, FIIs have recently witnessed an excessive net short position built up. The combination of a bull market correction phase and extreme FII short position has historically signaled end stage correction and early setup for the reversal rallies. Current market conditions are rhyming with those past instances. A repeat setup similar to 2023 year is visible, which is Nifty in corrective channel plus FIs at extreme net shorts. Historically, this combination has acted as a constrained bullish signal. Key monitorables would be development of bilateral trade deal negotiation and US Fed rates. Second, demand surge due to GST 2.0 from September 2025. That's pretty much it for today. Thank you all.